Well, good afternoon, everybody. My name is Lee Schwartz, and I'm the Director of Business Development for SVA Certified Public Accountants. I'd like to welcome you to the second webinar in our Vet Buy Sell series. This one's titled Veterinary Practice Valuations. Now, before we get started, I just want to take a sec and say a few words about SVA and our history with veterinarians. Like many of you, we got to where we are by being independent, and our vision moving forward is to remain that way and continue serving the same clients we have since 1974. And a huge part of that client base over these last almost 50 years now has been within our healthcare practice, which includes medical, dental, and of course, vet practices. Our mindset is that when you're a practice owner or practice manager, you have to work with someone who's more than just an accountant or a tax preparer. You need someone who's a true advisor working collaboratively with you. This webinar and others like it are just one small way in which we do that. So we have a lot of content to go over in the next 30 minutes, but we are going to try to leave a little bit of time at the end for some Q&A. So if you have questions, send them in, but we're going to save them until the end. So let me briefly introduce our speakers. I'm going to start on the right side of your screen, because if you've been on any of our past webinars, you're already familiar with Andy and Nate. But Andy Slinger is a principal and Nate Drykosen is a manager in our healthcare practice. And they work with practice owners and practice managers on efficiency, profitability, and of course, tax strategies. The bulk of today's presentation will be from our valuation experts. Dan Glomsky is a principal. He's accredited in business valuation, and he's a certified valuation analyst, in addition to some other letters he has after his name. And we also have Brian Thiel, who's a senior manager and a CPA. So a lot of people, we have a lot of information to cover. So let's jump right in. And Dan, I'm going to let you take it from here.
Thank you, Lee. And thank you, everybody, for participating and joining us for this series. The first thing I want to start with is a business valuation. And to help us in this process, we want to get a little poll question going here. And the question I guess we have is, which best describes your situation? Looking to buy a practice within the next 1 to 5 years, looking to sell a practice within the next 1 to 5 years, potential seller, but unsure of timelines, potential buyer, but unsure of timelines. So if we could get an answer from you, it kind of gives a sense of who's kind of participating, and then we'll, try to tailor a little bit more to that particular need. Perfect. Well, it looks like we're in the seller mode, and I think we see a lot of that, within the, the recent transactions. And well, I'd say it's probably a decent time to do that. So the place I want to first start an evaluation is a lot of times people are out there and they're saying, I should be getting X times my revenue or X times my net income, or I should be getting, X amount per employee, or, a variety of different, we call them multiples based on your business activity. And those are generally what I would view as a rule of thumb. And those are just numbers with no analysis. The rule of thumb data that's published is historical data, it's averages. I'm not saying it's necessarily bad data. I'm just saying it's just a surface analysis of things. Contrary to that, we have the valuation analysis. And as part of the valuation analysis, what we try to do is understand your practice as best as possible, go through the positives, the negatives, and have those factored into your valuation to kind of give us some insight as far as what a potential buyer, or even if you're the seller, how you can maybe leverage those positive or negatives and make them in a different result that you might desire. So then we want to talk about kind of what a valuation is and how we go about that. And the valuation, I always say the best way to describe a business valuation is very similar to a real estate appraisal. If you ever looked at a real estate appraisal, you'll notice that the appraiser goes through 3 approaches. They determine, what's the cost or net asset value of the property, how much income does the property generate, and what are other market comparables out there that could be used to say that the market value for your property is X. So a business valuation is very similar to that. We go through and we look at, how much the value of all your assets might be. Now, we're not doing an equipment appraisal or those types of things, but we look at other mechanisms that kind of give us a better or good insight as far as what your asset values might be worth. And then we also factor in an element of goodwill, which is generally speaking a big part of a veterinary practice, because it's the intangible that people are buying, not necessarily the tangible assets, and we view goodwill as an intangible asset. So we look at the net asset approach. We'll also look at the income approach, and the income approach is a process of us determining how much cash flow the veterinary practice is generating, and then we apply, what we consider as a cap rate to that particular cash flow, and that helps us determine the value. We look at a couple other things. And then the third approach is the market approach. And again, we have access to market transactions. We can see, similar size in revenue, similar size in profitability. We can try to right size your organization compared to the market data that's out there. Again, not an exact science from that perspective. And also the market data, we don't have always the complete story behind a transaction, but we do have quite a bit of detail. So we look at that type of thing. And then we also want to look at the 5 years of the practice. And we're really looking for what is the practice trend, and where are things going? Have they gone better? Have they gone worse? That type of stuff. And then we also will take that data and we'll compare you to what is your peers. And how are other practices? And these could be, clients that are, practices that are bigger, some might be smaller, that type of thing. But we get a general sense of how the industry is, and then how you, as your practice, might line up from that perspective. And some of the other things that we do as part of that process is, we want to look at revenue growth, and the revenue growth is important because a lot of times, and we'll get into this later, is that we have the economic trends, or what we would say transaction trends that are happening in your industry, whether it's a corporate buyer or a private buyer. And a lot of those are based on how much revenue the practice can generate. And we understand that there's various components of that revenue, but we're really keying in on what that revenue growth might look like. Hopefully it is growth. Over the last few years here, we've definitely seen a lot of growth, and that's great. But we want to know, are you growing, again, like your peers, or are you maybe trailing them, or are you really crushing it and going above and beyond them? So those things are, one thing we want to really get into and understand. The profitability of the practice is extremely important as well. You can have a great revenue level, but if we get to the bottom line and the profits just aren't there, then we got to start evaluating it. Why aren't the profits there? And, get to that analysis from a valuation perspective. The thing we want to make sure we all understand about a business valuation is it's forward-looking. Now, we're using historical data to try to predict the future, but the reality of it is, we want to understand where you're at right now and kind of project and predict what you're going to do into the future. And as part of that is the services offered, right? Do you do one procedure, exclusively? Are we doing multiple things and that type of stuff? Just to understand basically the diversity within your practice, and what kind of potential buyer might be interested in, what might be attractive to a buyer. And obviously the more things that we have attractive within that practice, the more buyers we have interested in your practice. And then obviously we would believe a higher value would be placed upon your practice. Another thing we look at is compensation. Again, what are you paying your prospective veterinarians? Is it market? Is it below market? Is it above market? What would a potential buyer do from a compensation perspective? Kind of make all those analysis at the same time. We're looking at the number of employees and what they do. And again, we're looking at what the capabilities or capacity of the practice is, and how we can leverage that and, again, produce a higher value if you're looking to position the company for sale. Equipment used, we're looking at, the age of the equipment, how, are you about ready to buy a big piece of equipment? Have you just recently bought a big piece of equipment? Those types of things. There's a lot of, you've heard stories out there where people just, continuously run the practice very lean and don't invest in capital, and the technology they have in equipment is way outdated and so forth. Those are all negatives that we need to make sure that whoever is the practice owner is aware of. I'm not saying we go out and buy all new stuff either. I think there's an equilibrium there we got to kind of work through. We look at rent. We want to understand whether you own the building or whether it's a third party, and those things would be some things we would do to, maybe market adjust the rent if it's a related party. But if it's a third party, in theory, it's probably market rent, and we're probably fine. But we want to make sure that if I'm selling a practice and I'm holding in the real estate, I might want to make an adjustment to that particular real estate or rent amount in the future, which could affect the valuation. Also, we want to know what products sales are, what the cost of the products are. How are you doing from that perspective? We look at, again, what are your margins on those activities? And again, how does it look against your peers the best that we can? And we continue to look at more things as we go through understanding your practice. But the most important thing is that we do understand your practice and that we get to the point where we believe that we could talk to a buyer or seller and say, here's the strengths and weaknesses that we, have, and put the best foot forward from that perspective. As part of the valuation process, we understand the practice, and now we'll try making some normalization adjustments to say that if I was an investor buying into your practice, here's how I would run it, and based on that, here's how much profit I might generate, and then here's the value that I would put on that particular profit generation. And as part of those normalization, the normal ones we normally see are some compensation adjustment, a rent adjustment. We try to remove one-time expenses as, again, we're looking forward-looking, and we want to make sure that the practice isn't artificially brought down in value because I made, I invested in an ERP system and I had some additional consultants coming in, putting that in practice. And there's other adjustments that could affect, we expensed off some old inventory or things along those lines that could impact the business. What I'd like to have Brian do now is talk about a little bit of some of the documents we request as we go through this process.
Thank you, Dan. Yeah, so when working with clients to start with, we kind of give a list of documents that are needed. A lot of those documents are what's your historical financial statements for the last 5 years, historical tax returns for the last 5 years, a current financial statement where you are to date, a listing of your fixed assets that you have, any that you're potentially looking to purchase or that you'll need to purchase in the next year or 5 years, information about the facility. Do you own the property that you're in, or are you leasing it from a third party? General demographics of your clients. Are there other competition in the area? So are there other vet clinics in the area? Do you have an emergency room facility? Do you have any covenants not to compete with other doctors? Revenue by doctors for the last 5 years. Compensation for the doctors for the last 5 years, any new client transaction or any new client transactions or new new customers for the last 5 years, number of active clients, and then new clients for the last 5 years, operating agreements. And once we get information from you, we will look at those items and look at your information, and that might have us ask more questions to get more information, depending on if we see something just off the start that might affect the evaluation. Those are kind of the general type things, but they're not all inclusive to start with. We'll probably ask for more as we get through your information. Dan, is there any other items you'd like me to discuss?
No, I think that's a good starting point. And when we go through the valuation process, we start with our general list of documentation requests. As we go through those, more questions usually come to light. And again, we want to understand that practice the best we can. And, it starts with looking at the information, almost like a due diligence process if there is a buy or sell transaction, so that we don't kind of get the surprises from that perspective. So thank you, Brian, for sharing that information. And we'll move on to the current valuation trends. And the best way to describe the current valuation trends are basically two types of buyers. There's the corporate buyer, and we'll call that the strategic buyer. And the reason I call it a strategic buyer is in a valuation structure, anytime you have a strategic buyer in play to buy a practice, they are in all likelihood going to be a higher value consideration. And the reason that is because a corporate buyer has various things that they can leverage. And so when we, as a practice operating by ourselves, we can sit there and we're going to incur the office administration. We're going to incur the prices that a vendor is going to charge us to buy our quantities, which are substantially less than what a corporate buyer might buy in quantity. And so what we end up having is a lack of buying power, lack of the ability to leverage maybe vets from different locations in our area and that type of stuff that might be part of that corporate buyer. So a corporate buyer multiple is usually what's driving these multiples on the higher side. So what I would say a range of some general market multiples are probably 0.9 times revenue all the way up to 0.1 or 0.14, 1.15. It can run, that high, but the reality of it is we always have to be careful on market multiples because it can matter how many vets you have. It can matter what your revenue level is. It can matter how many locations you have. There's a lot of variables that will drive whether a multiple is on the higher side or the lower side. But I would say, when we look at a private buyer, all the way up to a corporate buyer, we're kind of in that range of 0.9 of revenue to 1.4, 1.5. Usually we settle in between there. The private buyer will, as I kind of alluded to, is basically another veterinarian buying another veterinarian's practice, in which case they have to maintain all that overhead. They don't have the buying powers and so forth. So the offer that you're going to get from those particular veterinarians is going to be less, but it may be your only choice. It may be a desire that you want to keep it from being a corporate owned practice. There's a variety of reasons why people choose the private buyer versus the corporate buyer. But generally speaking, we see corporate buyers at the higher level and the private on the lower level from that perspective. So another multiple that we see in the trend is probably a 4 to maybe 8 times what I'll say is EBITDA, which is earnings before interest, taxes, depreciation, and amortization, for all those that understand the financial statement. But it's very similar to, let's say, net income. And that is, again, a range. And as I said before, the range is not something that you can dismiss, but where your practice falls, and there's always something that's up for debate. Then what I really want to now get into is why should a practice go into having a valuation done of their practice. And you can see the wheel here. Within each one of those is what I say is the need for succession planning. The mentality should always be is what's the end game? What am I building here? Am I building a practice with another vet, a younger vet that's going to eventually take over the practice, right? All those things are part of what you do currently, and then how we somewhat value the practice. But I would say that in my opinion, the reasons for having a valuation done on your practice is it helps you focus on areas of value that could improve the practice over time. Excuse me. And how much of that value actually, how does that translate to value? If you're ready to retire, again, succession planning need, but if you're ready to retire, how do I make sure that I'm going to get a decent amount for that, to the extent that I'm going to sell to a corporate buyer and that type of thing? But am I also going to get enough to retire? The next one I would have is ready to bring in another veterinarian, right? So I got a young veterinarian that I want to bring along, and now I want them to join the practice. How do I value and how much they should pay for that interest, right? Because they have now become a business owner along with yourself. Prepare for sale in the future. Again, these are looking at your positives and your negatives of your practice. How do we kind of diminish the negatives? How do we enhance the positives? Again, all translating to a higher value. And then you might be interested in buying a practice down the road or in the area or in another state, that type of stuff. We go through the practice, really evaluate what we think it might be worth, determine whether you're making the right purchase and so forth. But I work closely with Andy and Nate in this process, and I really want one of them or both of them to chime in and tell me what they think the number one reason that they believe that a practice should have a valuation done on it.
Yeah, Dan, I can start. These are all real important, but more than likely, you're only going to do this once, okay? And what we find is whether you're buying a practice or selling a practice, it can be a bit of an intimidating process to start and then go from start to finish. So this gets you on the best foot possible. You have the confidence and to negotiate from a position of strength. As Dan said, you know both the strengths and the weaknesses of your practice or of the practice that you're potentially buying. So again, you know potentially what you're going to be attacked with and what they're going to try to whittle away at in your weaknesses. At the same time, you can focus on your strengths. So it's just more of a robust process than relying on the back of the napkin calculation, something a friend said, or an article that you read online. It really gives you that confidence to move the process forward. Nate, any thoughts?
Yeah, and I think another common reason why clients tend to be curious about this and are interested in going through the process is, maybe they're looking to sell down the line in the relative short-term future, and they want to take a look at where their practice is right now, and then maybe make some adjustments to the way they operate and expenditures and investments to make their practice a little bit more valuable and build it up prior to sale. So having this done can be a good starting point as well from which to see and track how you improve over the years.
Thank you, Nate and Andy. Just kind of jumping off that one point though, quickly, Andy and Nate, we've worked through this before, and we've gone through a recent valuation where we look at the financials, and all of a sudden the revenue numbers don't appear to be tracking with the industry and so forth. So we talk to the the client, and we say, okay, well, your revenue is down. Have you increased prices in a while, right? And all of a sudden they increase prices, and they say, okay, well, that increase in revenue just increased your value of your practice by, $600,000, right? By being engaged in that practice and making that adjustment based on the market right now, there's a significant value in kind of having that reality faced with you.
Yeah, absolutely. And, as I think we've talked about in our series, I think almost to a T, you ask a veterinarian, are you charging enough? And it's almost universal that a lot of times, no, and this has been a year where we've really challenged you to not only put in your normal fee increase, but our survey showed that, this is the year veterinarians have put in, 2 or 3 price increases because you've never paid more for your stuff, your supplies, and for your people. So it's very important to make sure that your fees are always in line, and we tell you how it affects the value of your practice. And, now Dan and Brian can really attest to that.
So I think we have our final poll question before we go into some Q&A. So if you want to prepare those, that'd be great. So having heard the presentation, what do you think is the best way to value your practice? Just take an annual revenue multiply it by 5, compare your practice to one that just sold and use the same number, ask someone to make an offer. None of the above. Your practice is unique and using a simplistic approach when purchasing or selling a potential lifelong asset is rife with risk and reaps of disaster. Yeah, so everybody kind of answered this correctly, which is awesome, right? But the reality of it is we want to make sure that you understand your practice. And I can tell you, as part of a lot of M&A transactions, and Andy can probably attest to the same, what somebody thinks something's worth based on what their neighbor told them or so forth is one, it becomes a difficult number to overcome because somebody believes that that is correct. And then two, sometimes we can sell ourselves short, right? Because we have put a number that the practice is substantially undervalued at that number based on what you have going for it. So there's a lot of uniqueness there. Lee, I'll turn it over to you for questions and we'll try to address whatever we can.
Great. All right. That last poll question was a tough one. That was really made you think. All right. No, that's great. Thanks, guys. I know a lot of information to cover. We've already had a few questions come in. Let's dive right in so we can get to some of these. But please send them in if you've still got them. First question was, what was the effect of COVID on the value of vet practices?
Yeah, so a vet practice, COVID obviously was a very good scenario for veterinary practices. We've seen the statistics as far as increased number of pet owners, but the need to take care of your animal and that type of stuff had increased. So we've seen a lot of revenue increases. We've seen, the industry, corporate buyers become more interested in practices as a result of the wave of increase in revenue and that type of stuff. So obviously the more buyers we have participating in a market, that drives the value upward and so forth. I would say the private buys are a little bit on the lesser side because there isn't as many veterinarians that are available to buy a practice, but we do have some ownership transfers and so forth. I would say the bigger activity was on the corporate buyer side, but the values have increased, the revenues have increased, and profitability has increased. Andy, and you got thoughts?
No, I think you hit it on the head. Last couple of years, holding steady here in 2022, record revenue, record profitability, and we always advise, get multiple players involved in looking to sell your practice, and we've never seen multiples higher.
Okay, good. Let's do a couple of rapid fire questions because some of these are similar. So one question that came in was, does a valuation include a real estate appraisal? And another one that came in was, is one valuation enough or should you get a comp or a comparable from a different entity?
So generally speaking, we don't do real estate appraisals. We leave that to the real estate professionals. But if your practice is owned, you own the real estate and also operate the practice, that's something that we want to at least value understand what the value of that real estate is, whether it's looking at the real estate tax bill or getting an appraisal. So that's a separate component of that. And also is a separate component of a transaction, right? A corporate buyer might not be interested in buying the real estate, but just the practice, that type of thing. And if that's the case, we're going to want to have that appraised so that we know what the value should be. And the other question was, how often should you have an appraisal? Was that, or one was enough? Is that the question?
Yeah. Do you want to get, I guess, sort of competing appraisal or competing valuations so you get a better sense of the value, or is one enough?
Yeah, I would say one is enough. I think the biggest strength of the valuation process is understanding how evaluator or how an independent person might look at your practice. Certainly a second and third opinion is always something you can do. I just don't know if you're going to glean any value by doing that.
Okay, so a couple more very specific questions that came in. I'm wondering if knowing we're at about time here, maybe we try to wrap this up here, but let me just ask you one more, because we had a question about a practice with a boarding business. So how do you value a practice if it's got like an attached boarding business? You talk about how different that process would be.
Yeah, it's quite honestly, I would say it's got its benefits because you have that reoccurring revenue and so forth. The thing is, the veterinary industry currently is so strong, right? So that reoccurring business doesn't necessarily add to the value as much, but we do have the we'll look at that revenue stream. How much are you making on the boarding and that type of stuff? And that would be factored into the valuation as a kind of its own little component or business. So, you know, it gets factored in, but it's looked at a little bit uniquely.
All right, well, knowing we're at 31 after, anybody have any closing thoughts you want to leave our attendees with?
I would just say that, you know, be informed. Really understanding your business is probably the most important thing you can do to be successful in operating it and also improving upon it.
Yeah, and Andy, I think you mentioned it. It's worth repeating. It's probably the only time you'll buy or sell. You want to do it right. Thanks, guys. Lots of great information. We've got more stuff coming up. I'm going to wrap up today right now, but I just want to mention you can go to sva.com/vetseries to sign up for the other webinars in the series. You can also find news, information that may affect your practice. Part 3 of this buy sell series is on December 16th, and the topic is developing your strategy. So we talked a little bit about that today as well. But lastly, I just want to remind everybody that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. And if you're not currently an SVA client, contact me, Lee Schwartz, or anyone in our BD group, and we can get you the help or the answers that you need. Thanks for attending today, and hope you enjoy the rest of your afternoon. Bye-bye.